And then you can literally fund your lifestyle with the overflow without ever having to sell or get rid of your nest egg.
Yeah.
And then the more you invest, the more you grow that nest egg, and the more that nest egg throws off that cash that you get to spend every quarter.
Yeah, some of the investments I've done with Precision, I've made all my money back through distributions, and now
we're still paying you.
Yeah, I'm still getting paid that money, and I'm in for no money.
All right, hey everybody, and welcome back to How to Invest in Commercial Real Estate. And today we are talking about the cash flow. So one of the most important things when investing in commercial real estate, or really investing in anything, is getting a cash on cash return. You know, just cash flow in your mailbox, the passive income. That's what's most important here.
Yeah. So how does that differ from most people's idea of investments? Because I would say 90% of people, they just put their money in the market through their 401k. And they're not getting any cash on cash. They just put it in there and they just hope it grows. And when they're 65, they get access to it.
Yeah, and then the problem is once they want to sell it, then they're like, well, I don't want to sell it because now I've got to pay taxes on it.
Yep.
So they just let it sit there. At least that's pretty much what I've done with my stocks.
Yeah, and the key to income is really shifting as much as you can from active income, you're working for it, you're trading time for money, to passive income, where you're trading money for more money and not time. And that's what we're trying to talk about today, is the idea of investing money and cash flowing commercial real estate, and the ability to rely on that cash flow is huge and can be amazing.
Yeah, I think the big point about distributions is we are sending people checks every quarter. And so, you know, it's one thing if you give me your money and then in 10 years I promise you a certain return, and maybe in 10 years that return comes and maybe it doesn't. But by me sending you money every quarter, I'm reducing your basis in the investment. So effectively, we're reducing your risk. And the great thing about distributions is, like you said, you get money working for you. Not only is your initial investment driving distributions that we pay, but then you can take those distributions and you can reinvest those. And so now you're earning double on your invested dollars. And so for me, I think it's a great way to invest, is not just putting money in the market. That could be a strategy. But the power of real estate distributions every single quarter has been amazing for us and for our investors.
Yeah, and how many people have you talked to that said, "Hey, I don't want the cash flow. You just keep that." I don't know if I've talked to any of our investors that have said that.
No, they love getting the checks because it's a sense that the investment is working. They don't have to guess every quarter what's happening with it. No, we send the cash, the excess cash that the investments throw off. We send it right to them, and they can spend it. They can reinvest it. Just gives them peace of mind.
Yeah. So just last quarter, the third quarter of the year, we have a few months here. Just last quarter, how much did Precision Equity and Criterion send out in distributions?
Well, what I want to say first is these are my favorite times of the month or the year. It comes around 4 times a year. It's the end of quarters where we evaluate all of our investments and we get to decide how much money I'm going to send my friends, family, coworkers, relatives, anybody that's trusted us, that's invested with us. I get to send them money back. So it really is the best thing about what we do. But this quarter, I sent out about 150 checks, over $600,000 in net cash flow that we sent out to investors.
That's a ton of money.
That's incredible. Yeah, it's my favorite time of year too. I find myself as an investor, let's see, what month is this? Okay, so man, 30 days, it's my next round of checks. I can't wait. And then when they come, I'm like, well, now I got to wait another 90 days. But anyway.
Yeah, but at least it's paying you. At least it's paying you. And a lot of people, you know, we were on the phone with an investor, a prospective investor the other week, and he was saying, hey, I'm just really, you know, I'm a high W-2 earner. I make decent money, but I'm just trying to build up some passive income for retirement.
Yeah.
You know, eventually I don't want to have to work, and I'm not going to be making this active money. And I need to invest in something that's going to pay me every few months, because even though 90 days may seem like a long time, you can live off of getting paid 4 times a year, people. I mean, a lot of people do it.
Yeah, I basically replaced my W-2 money with those quarterly checks. So, and that's what, you know, you were talking about this investor, that's what he's wanting to do.
Yeah.
Well, so how many investments, for people listening, do you get to spend some of your earnings without having to sell the investment? Because with stocks, I mean, there are some dividend paying stocks.
Yeah.
Okay. But if it's just a typical IRA account or a 401k account or a Roth account, you can't get to the money. And even if you did, you have to sell the asset or parts of the asset to get cash flow.
Yep.
But here, you can get cash flow, but your money is still invested. It's still earning. We're still paying down that mortgage. the asset's still going up in value. And then you can literally fund your lifestyle with the overflow without ever having to sell or get rid of your nest egg.
Yeah.
And then the more you invest, the more you grow that nest egg, and the more that nest egg throws off that cash that you get to spend every quarter.
Yeah, some of the investments I've done with Precision, I've made all my money back through distributions, and now
we're still paying you.
Yeah, I'm still getting paid that money, and I'm in for no money.
Yeah, so let's talk about that. Obviously, when you go in and buy a long-term cash flowing deal, we're buying a lot of shopping centers. You could be buying an apartment complex, very similar structure. The sponsor is going in with a business plan. They're going to say, hey, we're going to kick out quarterly distributions. And they're probably going to rise over time because we're going to increase the rents or yada, yada, yada. So how do you as a sponsor go about evaluating what amount to kick out? Because obviously you're not just sending out all of the cash that business has. The business still has money left, right? But
yeah, a couple things we do is we always want to have a certain amount of money in the account in case we have issues. Maybe maintenance issues that aren't covered by the tenants. Maybe we have tenants that move out. The occupancy in an apartment complex dips. All of those factors can adjust cash flow. And the last thing I want to do is to go back to the investor and have to do a cash call and effectively reduce people's ownership if they don't participate in that.
Well, you probably don't want to reduce the check that they get. Right? If they get one check for this amount one quarter, you don't really want to go backwards either.
Yeah, consistency is really key. It gives them peace of mind.
Yeah, exactly. You definitely don't want to ask them for money, but you probably don't want to go down in your amount either.
So what we try to do is what I do, maybe some other sponsors don't do, is I pre-raise potentially a 5-year capital expenditure outlook. And so, what I don't want to do, like you say, is to have a capital event where I need some cash and I haven't raised for it, and now I've got to stop distributions in order to raise that capital and do a project. So for me, if there are projects that are going to be done, I'm going to raise that up front and put that into a safety account for the property, so I can still distribute the cash that the property is generating without having to re-raise any money for capital. Mm-hmm. And I raise capital expenditure money in addition to operating capital. So depending on how large the deal is, just with the fluctuations of cash flow and things that might happen, leasing commissions and TI and things, I'm also raising a decent amount of operating capital where it can ebb and flow with the monthly expense cycle, where we're never in jeopardy of not distributing what I've told them we're going to distribute, or having to raise a little bit of extra.
And you kind of have that operating income number sort of in your head each quarter when you're distributing, so that you say, okay, I'm going to keep that amount in here all the time. So if we get excess cash and it's well over this amount that I need for operating, then now it's time to consider raising the distribution.
That's right. So if I get, like we've done at Village South, which is a shopping center we have here in Tulsa, where the CapEx I over-raised, and then the property keeps exceeding expectation, so that CapEx budget just is getting too big, and to the point where it's excess. I don't need that much money in the account. That's when we start raising the distributions and paying even more money out to the investors.
Right.
So in essence, quarter over quarter, we're literally just distributing the profit really that property made, because you said we kind of go in and pre-raise CapEx or TI, or tenant improvements is what TI means, leasing commissions. You're pre-funding that, so it's really just, hey, the property made this much, or all of our properties, I guess, last quarter alone made like $700,000. We were able to distribute that to the investors.
Yeah,
that's a ton of money.
Yeah, to be able to shed off for us over $600,000, and Criterion's growing every quarter, and be able to pay that money out, it means we have a lot of profitable projects. And I would say we typically would distribute slightly less than whatever the profit is. Just because once again, I want to be consistent. And so if I have a dip next month, I don't want to be always dropping it and having people ask me, why'd you drop it? So we just distribute maybe slightly less than the NOI that we made. That way I can keep it consistent. And then if the account builds up, we increase it over time.
So you'll go a few quarters before you decide, okay, this is definitely on the way up, so now it's time to maybe go ahead and
go to 12% return to maybe a 14% return.
Yep. All right, so it's the end of the year. I'm filing my taxes, and Brian, you mailed me $100,000 last year. Do I just email my accountant and say, hey, I got $100,000 worth of distributions from Criterion through Brian, and what do I do? I'm assuming the $100,000 in distributions I got is all taxable, right?
No, it's not. So this $100,000, of course, you're going to get a K-1, and it's going to reflect how much your income or your loss was. And the income is offset by the depreciation. So, and other costs. I mean, when we operating account, we have our gross income, and then we have all our costs, utilities, maintenance, everything else. And then we're going to have a net income. And then that net income is kind of what's distributed. But then depreciation is taken off of that. And so we typically do, accelerated depreciation, right? Because
cost seg.
A straight line, 27 and a half years that normally you can depreciate, and that's what?
I think it may be
40 years. I don't know.
Long time.
There's a couple different types of property
there's different
types.
ways.
Yeah. 27 and a half, 39 years. But right now you can accelerate that.
Yeah. And we're going to own a property for, 5 to 10 years. So we'd rather take depreciation as quickly as possible, right?
Yeah. And in those first few years, you may have gotten $100,000 worth of distributions, but you may have gotten a negative K1.
Yeah. Right.
I mean, that's huge.
And so you owe zero taxes on that.
$100,000 of tax-free cash flow, and you're actually doing the right thing.
Yeah.
Yeah. So people, if you're in a high tax bracket, getting $100,000 in distributions, and let's say that first year or two, it's offset by depreciation.
Right.
To you, it's like getting $200,000 potentially.
Yeah.
Right.
With federal tax, state tax, Social Security, Medicare, 7.5% or whatever you're paying. So it's really, really powerful. And you say, well, Joel, I have to catch that back up. You do, but worst case, whenever we sell the property and you get that, we have to catch all that back up. You're only going to pay maximum about 24-25% on that money,
which is a lot less than like a
bracket.
single male surgeon. Let's just say, I mean, that's probably a 35-40% tax bracket.
Easily, but then with all
Maybe
the state and FICA tax and everything, it's a lot more. So it's probably almost half of a high income earner. Mm-hmm. And so it's not only do you get to pay half of the taxes, but you get to pay it years in the future. So that $100,000, you can be investing and earning 12, 15, 20% on that for 1, 2, 3, 4, 5 years. And so you've made enough profit to pay the tax that you're going to owe on that money,
right?
Even when we sell.
Yeah.
And that's a huge benefit. And people have to understand how depreciation works and how offsetting your taxes, how powerful it is to push that into the future and then pay on a 30% or on a half, 50% level that you would have otherwise paid.
Yeah.
There's a famous quote out there that we may have quoted several times in the show, but millionaires are trying to make more money and billionaires are trying to save money on taxes because 3% that they didn't pay that year on taxes on their income is tens and tens of millions of dollars. I mean, You've got to pay attention to taxes at some point in your life. You're going to have to pay attention to, hey, this is a more favorable tax environment to make money in, and I can actually keep more of my money.
Yeah, so that's a good point. I have a lot of friends that are high income earners, and so they're in the highest tax bracket. And they may work hard at getting better at their career and trying to increase their income. Okay, but even if they increase their income 5% a year, 10% a year, which is a lot, if they're paying half in taxes, the biggest bang for the buck on their time would be to educate themselves on how to pay less in taxes. Yeah. We're not trying to evade taxes. We're just trying to get depreciable assets and other things to help offset that. Right. And, of course, you're going to have to consult a tax professional in order to understand how to do that because there are limits to how much depreciation losses you can apply to your personal income, your active income.
Right.
So you have to kind of segment your incomes into active income and passive income. And passive losses can be claimed against passive income. Okay, but very little passive loss can be claimed against active income. So one suggestion, and we won't get into it today, is that I always suggest if people have the opportunity to have one family member be a real estate professional on a joint return, that will enable them to take unlimited passive losses against active income if they can qualify as a real estate professional. Or at least one of them can, and they're filing jointly.
Yeah, we literally just made a Facebook post about this, about how at some point in your real estate investing career, it may be advantageous to get a real estate license. And that was one of the key indicators is I think a real estate license gets you that designation.
I wouldn't say, let's say you're spending 60 hours a week as a project engineer. I don't think just having the real estate designation gets you there.
Yeah, I don't either.
I think you have to spend a certain number of hours a week. Again, though, if there's a stay-at-home spouse or maybe a spouse that has a part-time job and they start doing real estate, they can qualify. And since it's a joint return, once again, get some advice. But I think that's how you can really take advantage of the passive losses.
Well, and the IRS is very specific on that. So if anybody wants to look it up, you can find out what the IRS says you have to meet what qualifications you have to meet to be a real estate professional.
Yeah, but we're getting off on that. Today was about distributions.
Yeah, so there's another one. Net operating income, like Brian discussed earlier, isn't always what you're distributing out to the investors, because typically you're going in and you're leveraging the asset with some sort of debt. So you're taking this net operating income, your kind of gross profitability, you're paying your debt service, and then you have the distributable cash to your investor. In a big way, we structure our deals is getting long-term amortization schedules, and that really just gets the cash in our investor's pocket instead of the lender's pocket. And then you have to wait until it sells to get that money back. And I mean, that's
because your debt payments on a monthly basis are lower.
Yeah, allowing you to keep
so more bottom line income.
Yeah, which is that cash flow. So I mean that's the difference in paying out a 9 or a 10% return and paying out a 12 or a 13% return. It's just the AM schedule and how long your lender is taking to get paid back. And if you've got a strong enough asset, which most of the time we do, they'll allow you that longer AM schedule, which is huge.
Yeah, helps a lot.
Yeah, so the advice I want to give people today is get yourself earning passive income as soon as possible. Your number one goal as a worker should be to convert earned income into passive income. So every dollar you make, if you can save and get it invested wisely, then that money will earn you money without working. And pretty soon you'll build up the passive income to where you'll be like, okay, I'm spending all year working for $50,000, $100,000 a year, 40, 50 hours a week, over 2,000 hours. And this, now I'm getting almost an equivalent amount from passive income, and I'm not working at all for that. What am I doing at my day job, right? Maybe I should stop and focus 100% on driving this passive income.
Yep.
And that's the day your life changes. When you can substitute passive income for your earned income, you pay less taxes on it, so you don't need as much of it. And you get freedom. You get your freedom back.
I think we have to end it right there, because that poses some great question at the end of the episode. I mean, that's huge. That was a great one.
All right, guys.
We'll see you next time on How to Invest in Commercial Real Estate.